In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about an article by the International Monetary Fund which talks about the economics of talent. And in the second story of the day, I'll analyze and try to summarize a new CRISIL report that takes a look at what happened in the current financial year and what the next financial year could look like. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 11th of March. With that, let's begin with the first story. In the first story of the day, let's talk about an article by the IMF or the International Monetary Fund, which was written by Ruchir Agarwal and Patrick Gall, which takes a closer look at something called economics of talent. Now, I know at first look this might sound very odd to you because why on earth would economists study talent, which seems more like a topic for psychologists or even education experts, maybe? But don't worry, by the time the story ends, I'm sure you will have your answer. Now, the central idea here is quite simple. People have different levels of ability, and some individuals have a special knack for what they do, whether it's writing, painting, designing software, or even leading companies for that matter. Now, what gets economists interested in these special abilities is that they want to see how they affect the growth of entire economies over time. And that is what I want to get into detail in today's story. Now, mind you, this breakdown is by no means a comprehensive one. We as a team at Daily Brief are just starting to learn about all of this. Human talent, as you might have imagined, is incredibly complex, and we definitely don't yet have the complete understanding of things. So what we will try to do today is to give you a brief gist of the major bits of research that we have been able to read and have found interesting. And hopefully, as and when we come across more details, we'll be sure to cover that as well. Now, back to the story. When you look at a country as a whole, it is very clear that talented people can move the needle in a very big way. Talented people can come up with new ideas, they can start successful businesses, or they can even pioneer inventions. But the catch here is that talent alone does not always guarantee success for a person or for their country for that matter. It really depends on how well a society manages to recognize, encourage, and guide its own gifted individuals. One economist who studied this in detail, called William Baumol, noticed that in history, different periods rewarded different paths to success. In ancient Rome, for example, many so-called respectable people looked down on commerce and industry, and instead they focused on owning land or holding political offices to gain wealth and power. In medieval China, for example, government bureaucracy was the respected path. What Baumol concluded is that societies become very good at whatever their top people start to spend time on. So in a sense, in a well-functioning economy, talented people are actually pushed to innovate and create things, but in dysfunctional ones, they are instead exploiting loopholes or they are encouraging in socially wasteful contests. Now, this leads to the idea that in an economy, talented people are like a critical resource. They are just as important as things like money or raw materials. If they are placed in the right spots, like working on new technologies, improving businesses, pushing boundaries in research, etc., the economy as a whole benefits. But if they are placed somewhere unproductive or wasteful, the economy ends up paying the price. Now, economists often refer to something called the superstar effect, which means that in certain fields, just a handful of top performers can bring massive benefits to society. A brilliant CEO might have found an industry that did not exist before altogether, or a gifted scientist could develop breakthroughs that open the door to new products or medicines. Moreover, these standout individuals tend to raise the game of everyone around them. Research has also found that if a star scientist moves to a university department, that entire department's output can go up by almost 25% or so. And when a superstar researcher dies for that matter, their colleagues often experience a lasting drop in their own productivity. And because of all of these remarkable effects, economists are suggesting that if a government or society wants to kickstart economic growth, it is worth thinking about supporting talented people beyond just usual policies like cutting taxes or boosting consumer demand. A very interesting example is the United States between 1960 and 2010. More women and non white men started finding opportunities to join the workforce in high level roles. The talent pool basically widened overnight. Some scholars say that this broadening of talent may have been responsible for as much as 20 to 40% of America's economic growth over that half century. Opening the doors to more people, of course, meant discovering and nurturing more potential as a result of it. But still, raw talent does not really do much if there is not a system that helps these bright minds develop. You can see this very clearly in something like the International Mathematics Olympiads, which is a very competitive global exam for high school students. If two students from different countries both do equally well in the Olympiad, it suggests that their talent for math is roughly the same. But the thing is, if you trace their life afterwards, according to studies, students from a richer country are more likely to get a PhD, publish influential research, or even win major awards in their respective fields. Now, the difference is not really in talent like you may have imagined. It is really in what their home country has given them, which is good mentors, research facilities, scholarships, solid networks, and so on and so forth. Now, this is where the conversation about developing countries like ours in India comes in. See, if we truly want to unlock economic growth, what we need to start is by making sure everyone has a basic floor of resources and opportunities. Now, this includes access to quality education and decent healthcare so that truly gifted individuals don't really get missed or overshadowed just because they were stuck in schools with no resources or families that could not afford a proper education for them. But all of this is just half the story. The other half is deliberately seeking out those who have exceptional promise and giving them targeted support like gifted programs in early schooling, advanced high schools for top students, early admissions at universities, and mentorship programs where younger talent can learn from experts. Now, researchers often refer to what they call as the lost Einsteins, which means kids who could have been great inventors or scientists but simply never got noticed because of where they were born or how much money their family had. Now, one study says that children from families in the top 1% of income are about 10 times more likely to become inventors than equally bright kids from the poorest half of the population. Now, this big gap is not really because wealthy kids are inherently more talented. It is actually because the poorer kids rarely get identified or even guided along a path that suits their own potential. And all of this leads to one more major point. Talent tends to cluster together. See, as time goes on, these bright minds start to gravitate to places that already have strong ecosystems, which are places with good universities, major companies, or a bustling startup community. Now, when lots of talented people gather in one spot, their presence actually feeds on to oneself. Everyone in that area starts to become more creative and also productive by working alongside the others who are also similarly driven. And that is also how certain cities like Bengaluru in India came to be known as talent magnets. Now, these cities create a feedback loop of sorts where more talent leads to more opportunities, which in turn attracts more talent, and so on and so forth. Now, the same is very true for entire countries as well. The United States, for example, has an excellent research ecosystem that they have built over many, many decades. So, of course, it draws scientists and innovators from all across the world. And today, over 60% of the world's top scientists live in America, and that concentration sort of helps them remain a leader in innovation. And if you look at Nobel Prize winners, you will notice that most of them actually come from just three regions: the United States, Europe, and Japan. And this reflects how these places have figured out ways to foster and also pull in exceptional minds. Now, all of these highlights that I've just spoken about come together to highlight one big question. How do we make sure that the right people are doing the right things? That is, how do we ensure that someone with a gift for research actually ends up in a position where they can do research, or that a potential world-class entrepreneur has the support to start a company? See, for countries that are still building their talent systems, it is very crucial to get this right. If we ignore large parts of the population, we actually might start losing a generation of potential innovators and inventors. But if we do the opposite, which is broadly support everyone so no one's hidden gifts are unnoticed, then double down on those who show exceptional promise, we could see some massive benefits. You only have to look at the example of India's top engineering schools like the IITs, which have produced successful graduates who not only do well for themselves, but also create jobs and mentor younger people. Now, of course, there is more to be done. One or two institutions like the IITs are just a start, but they are not at all enough for a large country like ours. We definitely need more systematic ways of identifying and cultivating top talent, as well as offering them the networks and the resources to turn their abilities into real economic and social contributions. Because when talented people succeed, their success actually spills over to the rest of the society, which creates new industries, boosts productivity, and inspires others to follow suit. So, in many ways, talent actually has a multiplying effect. The more it is encouraged and supported, the more it spreads the benefits around. And that is why the article says that understanding and investing in talent might be just as important, if not more so, than many standard economic policies. Because when you unlock the potential of people who can change the world with their ideas, sort of everyone around them stands to gain. On that note, let's move on to the next story of the day. See, now that we're closing in on the end of this financial year, we thought it would be a good idea to sort of zoom out and see what the next financial year could look like for us. Now, a new CRISIL report that we came across does exactly that. It basically forecasts India's economic outlook for FY 2026 and it offers some excellent insights on it. So we thought, why not we simplify and serve the key insights for you in this report? Now, to begin with, CRISIL has tried to predict how the big numbers that we often talk about with regards to the economy, like GDP, etc., will change in the coming financial year. Now, the report suggests that India might grow at a rate of about 6.5% in FY 2026, possibly matching the same growth pace it expects for FY 2025. Now, of course, it is not as high as the 9.2% growth that India experienced in the previous year, but it is still considered strong when compared to many other large economies. Now, even though these numbers sound very specific at once, what we need to remember is that they are just predictions based on certain assumptions, like stable global politics and consistent oil prices. Anything like a sudden spike in oil prices or a major geopolitical conflict could really affect the outcome here. But still, a 6.5% seems like a very reasonable figure for now. CRISIL also believes that inflation could come down to around 4.4% by the year 2026, and this is lower than what we had before. CRISIL also predicts that the current account deficit, which is often written as CAD, might stay at around 1.3% of GDP. Now, for your very quick context, the current account deficit tells us the difference between what India earns through overseas countries and what we spend on our imports. A low deficit basically suggests that India is not in serious danger of running out on foreign exchange to pay its bills. Now, CRISIL also highlights that India has a strong stockpile of foreign exchange reserves, which are enough to cover 10 to 11 months of imports, which is a great buffer if something unexpected happens abroad. The report also talks about a world that is in a flux because global trade tensions have been on the rise. One reason for these tensions is that the US has been putting higher tariffs on imports, including those from India. Now, there are also political conflicts like the crisis in Ukraine and the Middle East, which can disrupt the flow of goods and make investors nervous. And when investors feel unsure, they usually tend to move their money into safe havens like the US dollar or gold, which can of course hurt emerging markets like India by pulling money out of them. Data from CRISIL also shows that a World Trade Uncertainty Index has jumped significantly in late 2024. This suggests that global trade has indeed been unstable. But even with all of these issues, the Indian rupee actually did not really fall as badly as it has in the past crisis, dropping by 4.4% in FY 2025, but staying steadier than before. India's strong foreign exchange reserves and a low current account deficit make it more resilient in this very uncertain world that we are living in right now. India also earns quite a bit from exporting services like IT and consulting. This income has helped keep the economy on a firmer ground even when merchandise exports, which by the way are physical goods like car or machinery, are not really doing so well. Over the years, India's share in global services exports has steadily risen, which has boosted our country's ability to handle bumps in the global trade. One more interesting claim in this report is that the Indian manufacturing sector could start growing faster than the services sector in the coming years. Now, the context here is that for a long time, India's growth story was mostly about services. You can think of the IT boom and the growth of financial services. But now, CRISIL actually expects manufacturing to grow at an average of 9% every year, which would be faster than services sector expected 6.8%. Now, if you're wondering, there are a few reasons behind this. First, many global companies have followed a China plus one approach, which basically means that they are looking for additional bases outside of China to spread their production risks. India, of course, is the big beneficiary because we have the workforce and we are improving our infrastructure to cater to these very companies. Our government is also encouraging manufacturers through things like PLI or the Production Linked Incentive Scheme, which offers financial perks to those who set up or expand factories in India. New areas like solar technologies, batteries, and semiconductors are also attracting major investments, which could potentially bring in anywhere between 8 lakh crore rupees and 10 lakh crore rupees into the country by the year 2030. Now, of course, none of this means that services will suddenly vanish in importance, but an added boost in manufacturing could lift its share of the total economy from around 17% to roughly 20% by the year 2030. The CRISIL report then talks about consumer spending, which has been sluggish in recent times. Now, consumer spending, for your very quick context, is a major part of India's GDP of around 60%. So when shoppers feel hesitant, the economy does slow down, and very meaningfully so. And that is exactly what we saw happening in FY 2025 when many consumer-facing companies complained that sales were very weak. CRISIL, though, now expects the turnaround in FY 2026. Part of the reason is that inflation is projected to cool to 4.4%, which should leave people with a bit more disposable income to spend on things like two-wheelers or home appliances. Food inflation, which was another big worry last time around, may also ease up because of better crop production. Another reason why spending might pick up this time around is the government's revised tax slabs, which allow many middle-class folks to save more on income tax. Some of that saved money could actually end up being spent on consumer goods or on travel. Now, of course, this assumes that global conditions do not suddenly take a turn for the worse, because if oil prices surge or there is another major supply shock, inflation could rise again, which could hurt purchasing power. CRISIL then also goes deep into how Indian companies, which are often called India Inc., will have to find larger sums of money to expand their operations. Now, the report suggests that the corporate sector might require about 120 lakh crore rupees in loans by the year FY 2026, and much of this borrowing will be used to build new factories or upgrade existing ones, especially in electronics, auto components, and chemicals. There is also a big push into renewable energy like solar and wind power, and big infrastructure projects are still underway, including better roads, improved ports, and smart city initiatives. Now, all of this, of course, demands huge amounts of capital. And in order to meet this funding need, India's banks and bond markets have to step up and also offer loans or invest in bonds. Now, banks right now are in a relatively good shape to lend a little more, but they do have to manage their money that they have in their deposits so that interest rates stay in check. Meanwhile, if the central bank reduces rates by another 50 to 75 basis points, borrowing might become cheaper overall, which could encourage companies to invest. So the overall tone of the CRISIL report is pretty optimistic, and it suggests that India's economy might keep growing at a healthy pace, with inflation possibly calming down and with enough foreign exchange reserves to soften any sort of blows from international upheavals. Still, as always, these forecasts are based on current circumstances. The world economy can be unpredictable and unexpected shocks can happen at any point in time. But if conditions do remain stable, CRISIL's figure of 6.5% growth, moderate inflation, and strong reserves could very well turn out to be true for FY 2026. And that brings us to the end of the two stories. With that, let's move on to the final section and talk about the quick news headlines. First, Hyundai Motor India has proposed 7 related party transactions worth 31,500 crore rupees for FY 2026, with major deals involving Mobis India of about 12,500 crore rupees, Kia India for about 5,800 crore rupees, Hyundai Motor Corporation for about 4,600 crore rupees, and Hyundai Engineering and Construction for about 3,000 crore rupees. Proxy advisory firms are split. Stakeholders Empowerment Services has opposed 6 transactions, citing governance concerns as these deals account for 40% of Hyundai Motors' revenue and over 50% of total purchases in FY 2024. Second, JSW Green Tech Limited, which is a JSW Group entity, is raising 1,487 crore rupees through a long-term loan to set up a greenfield electric vehicle manufacturing facility in Aurangabad, Maharashtra. The plant will have an annual capacity of 10,000 electric buses and 5,000 electric trucks, with operations scheduled to begin by July 2027. Third, Sun Pharmaceutical Industries has announced the acquisition of a US-based Checkpoint Therapeutics for $355 million US, offering 4.1 US dollar per share, which is a 66% premium over Checkpoint's last closing price. That's all the news and stories I have for you today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.